Dow just had its worst day in weeks, dropping over 700 points. But here's the thing, it wasn't really about stocks at all. The real story is bond yields, oil prices, and one retail giant's bad earnings report, and together they explain almost everything happening in the market right now. This week, the yield on the 30-year US Treasury bond hit its highest level since 2007. When bond yields rise, bonds start paying investors more just for holding them, which makes stocks look riskier and less appealing by comparison. Higher yields also mean higher borrowing costs across the board, for mortgages, for corporate loans, for pretty much everything that runs on credit. At the same time, oil prices climbed past $91 a barrel, driven by ongoing tension around the Iran conflict and worries about supply. Expensive oil ripples through the whole economy. Higher fuel costs, higher shipping costs, higher prices on shelves, which is exactly the kind of inflation pressure the Federal Reserve has been trying to stamp out. And that matters a lot right now, because traders had been betting on a rate cut in September. Those odds have been dropping fast. Then Walmart dropped its earnings report, and it wasn't good. Shares fell around 9%. The retail giant posted its slowest quarterly sales growth in more than 6 years, a red flag because Walmart is often seen as a barometer for how the average consumer is actually doing. When the biggest retailer in the country signals that shoppers are pulling back, investors start worrying that other retailers and the broader economy could be next. Rising yields, expensive oil, and a weak Walmart report, 3 separate stories that all landed the same week and pushed the market down together. The upside, if there is one, higher yields mean savings accounts, CDs, and money market funds are paying out more than they have in years. The bigger question now is what the Fed does next, because right now, the market isn't sure whether it's heading toward a rate cut, a rate hike, or nothing at all. Markets move on stories like this all the time. The key is understanding what's actually driving the number, not just reacting to the red. Subscribe for more breakdowns of what's actually moving your money.